Here is a question most people get wrong: which is the world's most international financial center? Not New York, not Tokyo, it is London. Around 40% of all global foreign exchange trading still passes through the city and Canary Wharf, more than any other single location on Earth. So even on a quiet Saturday like today, the 20th of June 2026, with the London Stock Exchange closed for the weekend, the decisions made here all week ripple across the entire planet. In the next few minutes I'll give you a clear, professional rundown of where London's markets stand, what moved this week, and what to watch when trading reopens on Monday morning. Let's be precise about timing, because it matters for your money. The London Stock Exchange runs Monday to Friday, with continuous trading from 8 in the morning to 4:30 in the afternoon, UK time. That means today, Saturday, there is no live price action on the Ftse. What we have instead is the full picture of the week just gone, and time to plan before the bell. This is actually the smartest moment to review your position. Professional fund managers in the city use the weekend exactly this way, to read the data calmly, away from the minute-by-minute noise, and to set their strategy before the rush of the Monday open. When people say the London market, they usually mean the Ftse 100, the index of the 100 largest companies listed on the London Stock Exchange, measured by market value. It's dominated by global heavyweights, energy giants like Shell and BP, banks such as HSBC and Barclays, the pharmaceutical leaders AstraZeneca and GSK, and consumer names like Unilever and Diageo. Crucially, around 3/4 of Ftse 100 earnings come from outside the UK, so this index often tells you more about the global economy and the strength of the pound than about Britain itself. For the domestic picture, watch the Ftse 250. Those mid-sized firms are far more exposed to the real UK high street and housing market. Nothing moves London markets quite like the Bank of England. From its headquarters on Threadneedle Street, the original old lady of the city, its Monetary Policy Committee sets the base interest rate that ultimately shapes your mortgage, your savings, and the value of nearly every UK asset. The committee of 9 members meets 8 times a year and votes publicly, so you can see exactly how split each decision is. The logic is simple even if the politics isn't. Higher rates cool inflation but slow growth and squeeze borrowers, lower rates do the opposite. Every word from the governor in the accompanying statement is dissected by traders for clues about the next move, which is why rate decision days are the most volatile in the calendar. The single number that drives those rate decisions is inflation, the annual rise in the cost of living, measured by the Consumer Prices Index from the Office for National Statistics. The Bank of England has a clear, legally set target of 2%. When inflation runs hot above that target, expect the bank to keep rates higher for longer. When it cools back towards 2%, the door opens to cuts that can lift shares and ease mortgage costs. For ordinary households, this is the most important figure to follow, because it feeds directly into food bills, energy prices, rent and wages. Watch the monthly ONS release closely. It is the heartbeat of the entire UK economic debate. 2 more gauges deserve your attention. First, the pound sterling. When traders expect higher UK interest rates, the pound tends to strengthen against the dollar and the euro, which is great for holidaymakers but a headache for those Ftse 100 exporters earning in foreign currencies. Second, gilts, UK government bonds, whose yields reveal what investors think about Britain's debt and inflation outlook. A sharp rise in gilt yields, as the country saw painfully during the 2022 mini-budget crisis, pushes up mortgage rates and government borrowing costs almost overnight. London never trades in isolation either. Moves on Wall Street, decisions from the US Federal Reserve, and global energy prices all feed straight back into the city. Financial London is more than just shares and bonds, property is woven through everything. The capital's housing market remains one of the most expensive in the world, with the average London home costing well over £500,000, far above the national average. Mortgage rates, set in the slipstream of the Bank of England, decide whether buyers can afford to move and whether the market cools or climbs. Meanwhile, the commercial property scene is still adjusting to hybrid working, with offices in the city and Canary Wharf reinventing themselves. Add in London's fast-growing fintech and tech sector, one of the largest in Europe, and you have an economy that is constantly reshaping itself. So as the weekend settles in, here is your practical watch list for the days ahead. Keep an eye on the next Bank of England signals on interest rates, the upcoming ONS inflation figure, and the direction of the pound against the dollar. Watch how the Ftse 100 opens on Monday, and note any major corporate earnings or dividend announcements from the big London-listed names. For the everyday investor, the lesson is timeless: don't chase the daily headlines, focus on the trend, and let the weekend be your moment to plan rather than panic. Let's bring it all together. London remains a financial superpower built on three pillars you can actually track yourself: the Bank of England's interest rates, the inflation numbers from the ONS, and the performance of the Ftse indices and the pound. Master those three, and you'll understand far more about your mortgage, your savings, and your investments than most people scrolling the headlines. Markets reopen on Monday. Use this calm Saturday to get ahead of them. If this London financial update helped clarify the bigger picture, stay tuned for the next one, and look after your money out there.